Welcome to the topic on money market. We want to understand various issues around money, and we will be discussing on before the advent of money. Where are we coming from? So we can always define money as what is generally accepted as a medium of exchange for goods and services. And before the advent of money, of course, we were using what we call barter trade, and this involved the exchange of goods for goods. And it had several advantages. Number one is that buyers and sellers were able to get goods and services immediately after exchange. And then there was improvement, or it improved the standards of living for those involved. The other one is that it promoted social relations of the trading communities, e.g., through intermarriages. And then we have it allowed for learning of different languages as the traders exchanged goods and services. It promoted the specialization in the production of goods and services. And finally, it helped a person to dispose of their surplus goods. Now, some of the challenges or disadvantages of barter trade were as follows. We have a language barrier. Of course, the trading partners maybe could not communicate with each other because of differences of language. Then we have indivisibility of commodities. Indivisibility of commodities. We have commodities that were indivisible. If, for example, somebody is carrying a goat and they are looking for a sack of maize, what happens if the person with the sack of maize only has half of the sack? Will this person who is owning the goat also split the goat to half? It was impossible. That's why we are talking about indivisibility of commodities. And then there was also perishability of commodities, for example, fruits and vegetables. There was also inconvenience in transporting some goods, and then required a double coincidence of want, and it could only trade with a person who had what you wanted. And then the other one is that it lacked a standard measure of value. Now, the money system, we look at the characteristics of money, divisibility. So we can always be able to divide what we have. And then we have portability. So portability simply means that it is easy to carry. I'm sure you have seen notes of different countries. They are made from a light material that is portable. Then the other one is homogeneous. By that we mean that it is the same or it is uniform. Then we also say that it is easily recognized or cognitive. So money can always be easily recognized. And the other one is it is generally accepted as a medium of exchange, and it is relatively complex also even to find, and also scarcity. It is relatively scarce. It is not readily available. You have to work to have it. And then we can say that it's durable, that is able to maintain physical quality of a reasonable length of time. That is in terms of durability. Then the demand for money. This is a very interesting subheading. There are different reasons on why people hold money, or why are individuals keeping money. Number one is the transaction motive. Number two is the precautionary motive. Number three is the speculative motive. No, transaction motive or transactionary motive is the motive of holding money so that you can be able to use that money for your daily expenses and activities. That is transactional. So if you look around yourself, you will see some few notes, some few coins. It means they have a purpose. That is transactional motive. Then we have the precautionary motive. One holds money as a precaution against unforeseen events, e.g. sickness. So it is for this particular motive that individuals will take up insurance policies, for example. Yeah, you aren't sure that you are going to be sick tomorrow, but because you are taking up precaution, you decide that to pay for an insurance cover. It's just a precautionary aspect. And finally is speculative. Speculative is when money is held with the expectation that in future it's going to give you an added benefit. And it is for that reason that people are investing in shares, people are investing in land, and people are investing in property that they are sure they will be able to get a return at a particular moment. Now we also have money has a number of functions. We have what we call the store of value. We also have money as a unit of account. We also have money as a medium of exchange. That is a statement actually we use to do our definition. And then we have money as a standard measure of value. And then we have money as a standard of deferred payment. I invite you for an assignment to seek clarification on the further meaning of these functions of money, and that will be part of the assignment that will be used for grading as you undertake this particular module. So make some notes on it, and that you are going to benefit even at the assignment level and at the end of evaluation criteria that I am going to be using for this particular module. Then around money, we cannot be able to discuss money and we have not discussed about commercial banks, and we say that there are banks formed with the main objective of making profit out of their operations. We have a number of commercial banks, and they also come with a number of functions that they intend to execute. Number one is safekeeping of money. That's why whatever amount that we have, we keep them in the bank, the commercial banks, because it is part of their functions to safely keep customers' money. The other one is transferring of money through checks, electronic funds transfers. The other one is lending money to borrowers. So people can be able to get loans, access credit through the banks. And also the other one is giving advice to businessmen on investment. So advice, you can always seek these advices from commercial banks when you visit them. The other one is acting as agents of stock exchange markets. And the other one is acting as intermediaries between those who save and those who borrow. Now, once we discuss commercial banks, then it will also be very important we mention about the central bank, and we say that is a government institution charged with the responsibility of regulating all monetary activities in a country. So the central bank, we say that it is the overall regulator of all commercial banks. So part of the functions of the central bank is, number one, to be able to issue currency. So in all countries, the central bank is a key institution in terms of issuing of currency and also the printing of currency. And then we have a banker to the government. The government maintains an account with the central bank where all revenues are kept. And then we have a banker to commercial banks. All commercial banks are required by the law to deposit a certain percentage of their deposit in the central bank. So that one is a policy. It is a law that whatever deposits as commercial banks that receive, a certain percentage is deposited with the central bank. And then we also have the lender of last resort. Lender of last resort is simply meaning that the central bank is the last option whereas commercial banks and governments can seek to borrow finances. And finally, is it acts as a link to external financial institutions, therefore facilitating inter-financial relationships. External financial institutions, I have just mentioned that, the IMF, the World Bank, the African Development Bank, and many other institutions that once they release any grant or any loans, the first stop is the central bank of a particular nation. And the other one is it facilitates clearing of checks between different commercial banks through its clearing house. Most of the time when you are making payment, let us assume you are making payment to Mask College of Business and Technology, and they are running the account with Diamond Trust Bank, and the check that you have come up with from your parent is an Equity Bank check. What do you think happens there so that Mask can be able to get that money now that it is not a DTB client who is paying? There must be some transactions between these two banks, and the central bank is going to facilitate that payment to be able to go through, of course involving these two institutions. The other one is the control of the monetary system, and finally is that it uses the instruments of the monetary policy either to expand or press the economic policies. We are going to discuss that more when we mention inflation. Tools of monetary policy. So there are different tools that we adopt. The monetary policy is what the central bank does in order to manipulate the supply, availability, and cost of money. So we have the bank rate as one of the tools that the central bank uses, is the rate at which the interest charged by the central bank to commercial bank when they borrow money. Yeah, so if we want to reduce the money in circulation, the central bank is simply going to raise this rate. And when it raises this rate, it means that the commercial banks will have lesser amount of money in to be able to lend. And then we have open market operations. The central bank can regulate the supply of money in the economy through selling of government securities, e.g. treasury bonds. Then we have the compulsory deposit requirement. The central bank requires the commercial banks to maintain certain amounts. We have mentioned that. The other one is selective credit. If we realize there is a lot of money in circulation, what the central bank is going to do, they are going to give instructions to commercial banks that they only need to lend to particular sectors and not others. And finally is on the moral persuasion, or what we call moral suasion. The central bank may request the commercial banks to reduce the rate of lending, and this would make supply in the economy to be able to reduce. So this one is a kind request that kindly reduce your lending. And finally, in the banking sector, we have emerging trends. We have M-banking, or what we call mobile banking. We have the use of the automated teller machines. I'm sure you've heard about them. And now, because of technology, like I said in one of the discussions, is that because of technology, we have now having advanced ATMs. The other one is customer care services. Of course, now they have been enhanced. The banks have adopted ticketing systems where you can pick a ticket and be able to be served. And number 4 is the giving of credit without requiring collateral, which is very, very important also, because it has expanded the number of people that are able to receive credit. And finally is the use of technology in banks, which has enabled quick and accurate transactions. It has enabled networking such that a customer can transact business from any part of the country. So we have internet banking. We have now every bank having software that they can be able to use, and that is crucial into ensuring that the banking sector continues to move and is able to succeed. That brings us to the end of our topic number 6 on the money market. Kindly, as you listen to this particular class, make sure you're also keen on creating interest in understanding more things that are going to assist you into understanding the concepts better.